Welcome back to the Live Off Rents podcast by Spark Rental. As always, I'm your host, Brian Davis, and today we are joined by a data analyst and veteran real estate investor, Neal Bawa. Neal is the founder of Grow Capitus, a real estate syndication company with over $660 million in assets under management. And I love his background in data analytics because he has such a unique take on finding value where other people miss it. And one of the things that really attracted me to Neal and what he's doing at Grow Capitus is they have this very unique strategy of ultra value add with some of their real estate investments. So, Neal, first of all, welcome to the show. And I am so excited to hear about your unique take on how you add value where other people can't in some of these real estate assets.
Sure. Well, the challenge in the US is that, almost every value add asset in the United States has already had value added to them. So almost every single project that we look at has already had upgraded units and upgraded bathrooms and, upgraded flooring. And so how do you continue to create value when this has already been done once in the last 10 years? And that's where ultra value add comes in. We noticed that in the 1970s and 1980s, there were some projects in the United States where because those projects were maybe built on slopes or whatever reason it might be, or the land was so ridiculously inexpensive back then, that apartments were built on, let's say, a piece of land that allows you to build 20 units an acre, but they only built 12, or they built 14, or they built 15. They just didn't build as many as they should have. Now, normally, that doesn't help us because if they just spaced them out a little bit more, we'd have to knock them down to build more units, right? But every once in a while, if you keep, as you're going through your normal due diligence for these properties and looking at these properties as a regular value add property, you come across a property where a trained eye or data analyst can say one portion of this property looks completely empty. There's just a big gap there. Maybe they planned to make that a second phase and they never built it. Or maybe there was a tennis court there or two tennis courts there, and now there's just nothing, and because nobody plays tennis anymore in apartment complexes. Whatever it might be, it's clear that I'm seeing the property from the top and there's a portion that's empty. And that's where ultra value add comes in. Ultra value add is a strategy that basically buys an existing property, continues the value add plan the way that we were going to. But that value add plan these days, if you're being honest with the underwriting, is only going to take you to about 14% IRR or 16, 17% annualized return. More than that, you really have to push the numbers. And so how do you get to this higher number? Well, what you do is, before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neil's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. You talk to your bank and you find a bank that basically does construction projects on the site. So they're doing other projects which are, just raw land to construction. And you convince them to give you a loan, but two different kinds of loans. The first loan is just a regular loan for the property. It's like any regular loan. They basically give you a loan for the property. And then the second loan is to give you a loan to build additional units. Now, the benefits of this are so huge compared to new construction. New construction is risky. It's very difficult to do it when you don't know what you're doing. You really need a development company. But imagine all of the things that are checked off here at this property, compared to the other one. Number one, the property already was very large in size and they didn't build a lot of units. So you probably have plenty of space for parking. The example that I'm going to give you in a minute, there was already so much parking that we didn't have to build any parking for 29 additional units because there was already so much parking, and a lot of AD's properties just had ridiculous amounts of parking, right? The second thing is zoning. Well, the property is already zoned multifamily, so you don't have to worry about zoning. And entitlements. I mean, it's already entitled for a certain kind of unit. You have to take the existing drawings, give them to an architect and say, I just want you to plop this. Don't change anything. And the city couldn't possibly have any objections to something that they had already approved in the past. So now you don't, the approvals process becomes a lot simpler. So the conversation with the city is simply this: hey, we're buying this property, and we noticed that from a zoning perspective, this property can have 20 units an acre. It has 15. Would you let us build 5 units an acre? On this particular property, here's a straw design, drawing which costs $2,000 or $3,000, and we'll do all the design work after we buy it. That's ultra value add. Park Canyon is a property in Dalton, Georgia, and when we bought the property, it was 51 units. And we looked at it and we realized that there was plenty of land on this particular property. Guess what we did? We went to the city, followed the same process, built 29 more units, and we ended up making more than 30% IRR because those 29 units basically had $100,000 a unit cost. That's what we built them for. And they were very nice, brand new 2023 built 9-foot ceiling granite countertops units. And you can imagine the rents were pretty nice for those kinds of units. That's ultra value add.
Well, I love that, and there's so much there to like. I mean, from the fact that you have much lower risk with developing, a new building there, given that you already have all the zoning approvals and all of that in place. You don't need to worry about perk tests or any of these other kind of new construction concerns, and you still have all the cash flow from the existing units while
Exactly.
you're building out the new ones. So it just takes so much of the risk out of it. Now, I've heard you mention before that this ultra value add strategy really works best when interest rates are lower. So I'm just curious to hear, why that is, and what's the math behind that?
So two different reasons. One is you can either choose to just get a regular loan on the portion of the property that and in which case it could probably work today as well. And then what you do is you ask your existing investors, the people that gave you the money, to give you cash to build the other units. So the additional units, you don't take a loan on it, you just build it in cash. With Park Canyon, we raised $2.9 million as pure cash from our investors to build 29 units, so $100,000 a unit, no debt, no leverage. Of course, our existing lender knew that's what we were doing, and they were like, "That's fine. It's going to increase the value of my asset, so I'm not giving you any money for it, so that's fine." But if you have to take debt, what happens is now you have 2 loans, and now the first one becomes more expensive. So it's harder to do ultra value add unless the Fed funds rate is somewhere around 2.5. Right now it's 5.25. So it's not a strategy that we'll look at until we get into 2026.
No, that makes perfect sense. Yeah, and I love that whole notion of going out there and making some of these numbers work on properties that your competitors are not able to make work. So yeah, you're able to go in there and buy at an 151 unit count in that example, and then sell it at 180 unit count with all of that extra revenue and all the extra valuation. So that's great. Neil, in 30 seconds or less, how do you help people, and how can people connect with you if they want to take you up on that help?
We have over 1,000 investors, and we've taken about 325 million of their money to buy or build about a billion-dollar portfolio. 2 different companies: Grow Capitus, which buys, and improves, and Mission 10K, which basically builds townhomes from scratch. And you can find us at Multifamily University or multifamilyu.com.
Love it. Well, guys, if you enjoy these quick, focused conversations that we have, please rate, review the show. It makes a world of difference to us. And on that note, we will catch you next time.